Today's forecast. I'm pleased to present a modest and helpful improvement in the state's revenue outlook. This improvement does not mean that the state's budget crisis is over. We still are projecting a $5 billion budget deficit for the fiscal 12 and 13 biennium. Nonetheless, this represents material improvement in the underlying economy, and particularly in the state revenue impact from congressional action of just a couple months ago. As you see on the first slide, we are anticipating a roughly $1.2 billion improvement in revenues and expenditures for the 12 and 13 biennium.
So in November, our forecast was based on the assumption that federal law would be showing a 20% capital gains tax rate, and now this lower tax rate is in place. Why does that make a difference? Well, with a lower tax rate, we see greater turnover of portfolios. That increases the amount of actual income that's generated from sales, and that increase in income increases the revenues for the state. The bottom line is that Minnesota taxable income is higher than it would have been with a higher federal tax rate. What's interesting and a little bit surprising and unusual about this forecast is that so much of the additional revenue came from such a small portion of the tax base. Minnesota's capital gains are about 3% of total adjusted gross income for Minnesota residents, and yet they generated 65% of the additional revenue in this forecast.
Thank you to the employers and the employees of the great state of Minnesota. Their hard work, their investment in our great state, their investment in new ideas, entrepreneurs that went out and took that great leap last year allowed us to be in a lot better position than many of us were expecting come today. This will obviously help with some of the budget that we're going to be working on in the next few weeks here, but this is a message that no one in government should pat themselves on the back here. This is the hardworking business women and men of our great state that helped us this point.
The number that we're looking at, Tom, is with this new projections, we would have an increase in the revenue from the last biennium of 8.7%. So almost 9% now increase in state revenue from last biennium. And as we've said with the previous numbers, I mean, 9% for a lot of families, for a lot of Minnesota businesses would be enough. And so we're saying with what's in the checkbook, let's live within that, let's compromise within that, let's prioritize, let's reform, and we will be healthier for it. Our economy and our budget will be healthier for it.
Tax relief plus certainty equals economic growth. That is a really important formula for us to remember. We keep talking about how this session cannot just be about cuts, and this session cannot just be about tax increases. We've got to introduce this third idea, this notion of growth. And so at the federal level, we saw some growth. And that came out of an agreement between the president, a Democrat president, and a Republican Congress. So I hope there's a lesson in there for the Minnesota political scene.
What we know for certain is that a continuation of Governor Palente's failed policies of the past is only going to stall our recovery. Republican majorities in the legislature want to cut middle-class jobs when what the state needs is more jobs. Republican majorities want to continue Palente budgeting, putting a greater and greater squeeze on middle-class pocketbooks by increasing property taxes, tuitions, and fees. We know that this all-cuts approach won't work. It's the very approach that made our great state perform below average over the last decade.
What's interesting in the numbers is about 40% of the improvement is directly related to capital gains because of the extension of the December tax package. So it's not really that the economy is improving, it's that just people moving money around because of the improvement in the stock market is creating 40% of the improvement. So that's helpful, but it's hardly improvement because of an economic recovery.